Good day, everybody. Thank you very much for having me. I'm pretty much totally today going to tell you how the world is going to unravel. 40-minute presentation. I think we're going to have 20 minutes for questions afterwards. So if you can hold the questions, that would be great. The focus mainly is going to be on the US economy. That will be the probably first two-thirds, but after that I am going to look at some potential world issues that are out there at the moment, because of course, the US is no longer an island, and we've seen that our markets can get moved and buffeted quite a lot by what's going on elsewhere. I think this morning we'll talk about how weak global demand and tighter financial conditions are still downside risks. Obviously not perhaps quite as much as we thought a few months ago. But even so, I don't think they're going to derail a wider economic recovery here in America. The one thing that does derail recoveries is the Fed. It's the Fed that kills recoveries and causes recessions by raising interest rates too far. The Fed has raised interest rates once, but as we'll talk about this morning, in real terms, interest rates are still very, very low, and there's no reason to believe that this recovery is about to end anytime soon. Now, for the last year or two, the focus has been very much on deflationary risks, not just globally, but also here in the US. One key point I want to make this morning is that I think the focus is going to change there. We've seen commodity prices fall, but they now appear to have levelled out. We've seen the dollar surge, but also that appears to have levelled out too. And so the focus is going to be more on higher inflation through the shrinking slack in this economy, which is going to start to trigger mounting domestic price pressures. So over the last few months, there's been quite a few fears that somehow problems in emerging markets could cause a recession year in the US. Well, I think in terms of just looking at the direct trade and financial links, that's probably not going to happen, simply because those links are too small. For the US economy, exports are only 13% of GDP. And if you think about China, the biggest of the emerging markets, well, US exports to China are only 1% of GDP. So basically, the Chinese economy could pretty much disappear, and US GDP would only be down by 1%. So that's certainly not going to cause a recession here. The financial links are also fairly limited. Of course, because of ownership rules, it means that US companies don't own a lot in terms of financial institutions in China. But there are other reasons why the shift in Chinese growth from something that was around 10 or 11% a few years ago to something that's nearer 5, 6 or 7% now is having an effect into the US. One is that it's caused a global rise in the value of the dollar. And two is that the slump in energy prices, some of which is about weaker Chinese demand, has also arguably been a drag on the US economy. And of course, it's talking about even if the Chinese economy disappeared, it wouldn't send the US economy into recession based solely on the trade links. Well, the Chinese economy isn't anywhere near recession anyway. This chart shows you the Chinese manufacturing PMI, which is the red line, and you can see it tends to have a pretty close historical relationship with US exports to China. Now, US exports to China, the blue line, the growth rate has disappointed a little bit, but you can see, based just on that manufacturing PMI, well, US exports to China shouldn't even be shrinking at all. They should actually be going up slightly. So all this concern we've had over the past few months that we're about to see a collapse in China that's going to drag down the US economy as well. One, not only is the scope of US exports to China big enough to do that, but two, we don't even have the weakness in the Chinese economy to suggest that we're going to see a downturn in exports to that region. Of course, the rise in the dollar has been a much more negative effect broadly for the US economy. In nominal terms, the dollar on the trade-weighted basis has gone up by almost 20% over the last couple of years. But the better news is that over the last 3 or 4 months, it's now fallen back by almost 5%. Now, in fact, this chart is a tiny bit out of date. So you can see that big run-up was obviously a very big negative last year. Two effects. One, it dampens core inflation. Two, it begins to hit net exports quite heavily. Particularly on the second one, we can see this chart shows you the level of real imports and real exports of the US economy. Now you can see the red line and the blue line were both going up pretty much in tandem for 2012 to 2015. But around the end of 2014, which is when the dollar began to rise, we can see a change in that relationship. Imports are still rising because domestic demand here in the US is still looking pretty solid. The key difference is that real exports, the blue line, have begun to fall off. Now, that's made net external demand a pretty big drag on overall GDP growth. So last year, for instance, US GDP growth was 2.4%, but that included a drag from net external demand, so that's the difference between exports and imports, of about 0.5 percentage points. Now that drag is going to continue this year as well. It will be a little bit smaller. But the good news is if the pace of the dollar's rise slows markedly, and certainly it appears to have done over the past few months, that drag will get smaller this year and by next year should have disappeared. So that's very positive for the US economic outlook overall. Now, admittedly, the short-term US economic outlook isn't that good. As many of you will know, most estimates for first quarter GDP growth have been coming down quite substantially. Our estimate is that the first quarter GDP growth was only 1% at an annualised pace. I'm sure many of you follow the Atlanta Fed's GDP Now forecast, which suggests it was even weaker. Should we be worried? I mean, certainly if you look at the last three endpoints on this chart, that suggests GDP growth has been slowing through each of those quarters. I think the answer is no. As I said, we've had a big drag from net external demand over the last few quarters. In addition, the first quarter also had a drop back in motor vehicle sales, which is quite substantial. We'll talk about that a bit more in a second. And also we've had the fallout from the big collapse in commodity prices. So that's definitely hit the shale oil industry, and we've seen a big drop in mining investment. But I think as far as the rest of this year, everything is still looking pretty good. Just staying on this chart for a second, I mean, you can see that there have been periods during this recovery when GDP growth has temporarily slowed. There's even 2 quarters in this recovery where GDP has been negative in early 2011 and early 2014. Yet the recovery has rebounded and carried on. In this case, if we look at the most forward-looking survey evidence from the 2 ISM manufacturing and non-manufacturing indices, what we see is that late last year there was a lot of weakness, particularly in the manufacturing PMI. Now, of course, that's exactly what you'd expect in an environment where the dollar's getting much stronger, because, of course, the manufacturing sector is the one that's most export intensive. But most recently, over the last couple of months, we've begun to see quite a marked rebound. You can see the blue line, the manufacturing PMI, improves quite a lot, now back above the 50 level, and even the non-manufacturing index has improved. So to me, that suggests that the second quarter and the second half of this year are going to be a lot more positive. Now, as I mentioned just a second ago, I mean, in the last year, business investment has been very, very mixed in the US economy. What stands out, obviously, on this chart is the green line, which shows you what's happened to investment in mining structures. Now, the rapid drop in the oil price, which took it from above $100 down to at one point pretty much $30 a barrel, has had a very dramatic effect on mining structures investment. As you know, drilling activity fell from about 1,500 active drills in the economy to about 300 drills in the economy. And when we translate that into overall mining investment, it's something like a 50% drop over the last 12 months. Now, the good news there is that that decline is not going to continue for much longer. We already know that crude oil prices have pretty much leveled out. pretty much shortly we would expect drilling activity to level out, and therefore investment in mining structures will also level out. Now this isn't a positive in terms of very strong growth, but we are at least taking away one of the negatives that we had last year. Offsetting some of that negative last year was a much stronger performance from commercial property investment. So in this chart it's called non-mining structures investment, which is the blue line. Now, of course, it looks pretty modest relative to the massive decline in mining structures investment, but it is still growing at a more than 10% annualised pace, which is pretty healthy. Commercial real estate obviously has had a number of years of weakness, but now does appear to be improving, and improving for a lot of good reasons, which is there's not as much spare capacity in either the commercial or office markets as there were before. So that's again something which I think is a positive. But of course, when we come down to the US economy, the one thing that is the key driver is the consumer. And here things have been a little weaker over the last few months. This chart shows you the red bars are the monthly change in consumption, and the blue bar is the 3-month and 3-month annualised rate. Now you can see there's been a gradual slowdown in that blue line, pretty much since the middle of last year. And in particular, we had a very weak January and also a fairly weak October. Now, that means that for the first quarter as a whole, real consumption growth is only going to be around 1.5%. Now, in many ways, that's quite disappointing, obviously. But as I'm about to argue, I think there are a lot of positives for the consumer outlook. And certainly the fundamentals appear strong. And I would expect to see a lot better performance through the rest of this year. One of the key reasons why the first quarter was weak is we've seen quite dramatic drop-off in motor vehicle sales in the US economy over the last few months. Obviously last year was a near record year for motor vehicle sales. They were particularly strong. Light truck sales were doing really, really well with low gas prices and also a turnaround in the construction industry. And we got towards the end of the year up to a pace of around 18 million vehicle sales at an annualised pace in those final few months. But that doesn't appear to have been sustainable, and in particular we've seen a very sharp drop-off over the last couple of months. But I don't think that's any reason to panic. I think that's more, by the time we got to the end of last year, sales were just unsustainably high and were due for something of a drop back. And I think manufacturers also share that opinion, because although sales have dropped back over the last couple of months, we have actually seen manufacturers' production increasing. So they do seem confident they will be able to sell more vehicles through the rest of the year. But particularly this drop-off in March, we took vehicle sales down to 16.5 million at an annualised pace, is really going to do some damage to first quarter consumption growth. The other thing that's been a little bit disappointing is that 1.5% consumption growth I'm talking about for the first quarter comes against a backdrop where gasoline prices have fallen obviously quite sharply, not just over the last 12 months, but even in January and February too, we had another downward leg. Now you would hope we would see that in terms of stronger real consumption growth. If people are spending less to fill up their vehicles, they should have more money left over to spend on other goods and services in the economy. Now, the red line here shows you the cumulative change in nominal spending on gasoline has actually fallen by about $170 billion over the past 18 months, 19 months. That's a fairly big sum. That works out at about 1.5% of consumption. So if US households have gone out and spent all that other money, all those savings on other goods and services, we would have expected to see a boost to consumption of as much as 1.5%. But unfortunately what's happened is a lot of that money has been saved. Now the blue line in this chart shows you that as spending on gasoline has gone down, we've also seen a mirrorage rise in saving. So the blue line shows you the cumulative rise in saving over this same period. And you can see that household saving has risen by about $110 billion. So not all of this money has been saved, but quite a lot of it has been saved. The question, I guess, is this money going to be spent in the future? If we'd been doing this talk 12 months ago, I probably would have made an argument that it was going to be spent. A lot of the savings were going to low-income, credit-constrained families. But it's much harder to do 18 months down the road. By now, households should know that this is potentially a permanent change. But since we haven't seen it yet, I don't think we necessarily will in the future. But that doesn't mean that consumption growth can't still continue at a solid pace, because the fundamentals underlying consumption with income are pretty good. Now, the key driver of consumption growth in the economy is income, and the key driver of income is employment. And what we have had consistently throughout this recovery is strong employment growth. And that continued throughout the first quarter as well. Even though we think GDP growth slowed, employment still continued, expanding by over 200,000 per month. And this is the key, because even if we don't get strong growth in average hourly earnings, so hourly wages, we're getting so many people back into employment that's driving income growth of around 3 to 4% per year, and that's enough to drive a pretty strong performance from the US consumer. As I said, we haven't seen average hourly earnings growth accelerate that much during this recovery yet, but I don't think that's a long way away now. At this stage, we've got the unemployment rate down to 5%. At one point, at the peak of the downturn, we had the unemployment rate as high as 10%. So that's quite a dramatic turnaround over the past few years. Now, of course, some of that decline in the unemployment rate has been because people have actually left the active labour force, so the labour participation rate has come down. Some of that is, of course, a structural change. It's to do with the demographics in the economy. So we've seen the baby boomers reaching retirement age, and not all of them, but many of them have left the labour market. But even if we look at the employment to population ratio, which is a much broader measure of what's going on in the labour market, we can see that over the last few months that has been rising quite substantially, and that suggests that the slack in the labour market is going down. And when the slack in the labour market goes down, we would naturally, as an economist anyway, expect that to be reflected, not necessarily immediately, but certainly reflected at some point fairly shortly afterwards in terms of stronger wage growth. Now, we've seen certainly a lot of anecdotal information about stronger wage growth. The Atlanta Fed calculated its own wage tracker, which suggests growth has taken off. We're also seeing many states raise the minimum wage. But on an aggregate level, we're not quite yet seeing it come through in the statistics. Last year was very much about the two big deflationary shocks that hit the economy. One was the collapse in commodity prices, and the other was the surge in the dollar. But those deflationary shocks were very much temporary. As I said, we've already seen most commodity prices level out, maybe even rebound a little bit. And what we've also seen is that the dollar has at least stopped rising, and maybe temporarily has actually given back some of those gains. So I think that's very, very important if we're thinking about what the Federal Reserve is going to do with interest rates, because it means over the next 1 to 2 years, the key driver of inflation is not any longer going to be these deflationary shocks, because they're no longer there. It's going to be about what's happening domestically to price pressures. And if we've got this environment where, if we just go back here, we've got a much lower unemployment rate, a higher employment to population ratio, suggesting that there's a lot less slack in that labour market, it is going to start to generate wage growth, it is going to start to generate higher growth in unit labour costs, and it is going to start to generate stronger core inflation. Now, the Fed was able to delay raising interest rates last year because of various global risks that came up, but mostly only because inflation was so low. In an environment where inflation is rising and getting back towards the Fed's 2% target, I think that's going to be a lot harder to do. This chart shows you the two key core inflation measures for the economy, the CPI measure and the PCE deflator measure. And you can see that in both cases there's been a fairly dramatic rise over the past few months. Now, Fed Chair Janet Yellen has said that she's not convinced yet that these increases are durable, but I would argue she's wrong about that. But either way, the data should tell us over the next few months whether she's right or I'm right. You can see here, we talk about the impact that the stronger dollar has had on inflation over the last 12 months. This chart shows you the relationship there is between the broad trade-weighted dollar, which is the red line, and how that affects import prices for goods and services coming into the economy. And you can see, as you would expect, when the dollar's going up, that means that import prices should be coming down. But the key thing is that the pace of dollar appreciation has slowed very, very markedly. So you can see the growth rate on that broad trade-weighted dollar at one point was close to 15% year on year. It's now down to less than 2%. And that means we're going to see a sharp slowing in import price growth in the rate of decline in import prices too. And that's going to come through in stronger core inflation over the next 12 months. Now, our forecasts show a continuation of that upward trend in core inflation. As you can see, we think for the CPI measure it's going to get above 2.5% by the end of this year. Now, for some time, headline inflation is going to remain low just because of the base effects surrounding what's been happening with energy prices. But if energy prices remain at current levels until towards the end of this year, we would then expect headline inflation also to begin to rise quite dramatically towards the end of this year. And if crude oil prices and gasoline prices remain where they are now, they'll actually turn into a small inflationary force early next year. Of course, to some extent, the market's already facing up to this possibility. Now, the Fed, as I've said, Janet Yellen's not necessarily convinced this is a durable increase, but if we look at break-even inflation rates, so that's the gap between yields on inflation-linked bonds and nominal bonds, we can see that over the last couple of months there has been something of a rebound there. So this is something that the markets are also beginning to take into account. So I think that leaves this year the Fed stuck something between a rock and a hard place. On the one hand, it has a weak global economy. That suggests it should remain unusually accommodative for as long as it can. We'll talk about some of the risks that are out there in a minute. But as I said, the external deflationary pressure that it had that was making its job a little bit easier last year is fading quite rapidly. Now, the US economy obviously is not on fire. Economic growth has been 2 to 2.5% over the last few years. But the key thing to remember is that the economy's potential growth rate is much lower than it used to be. So the average in the post-war was around 3%. But of course, that's at a time when we had stronger labour force growth and also when we had stronger productivity growth. The truth is that now the potential for this economy is probably nearer 2%. So if we get actual GDP growth of 2 to 2.5%, that's a pretty good result. Under those circumstances, as I said, we've seen the unemployment rate come down quite dramatically over the past few years, and 2 to 2.5% GDP growth has been enough to get rid of the excess slack in the economy. And that means at some point the Fed's going to have to start to normalise interest rates and do a lot more than it's already done. Now, obviously the Fed still thinks it can be fairly relaxed about this. Very colourful chart, but this shows how our forecasts for the Fed Funds Futures rate line up against the FOMC's projections, also the Wall Street Journal consensus estimate, and Fed Funds Futures. Well, you can see that as far as Fed Funds Futures go, that's where the really big gap is. The markets, it appears, that are pricing in barely any rate increases over the next couple of years. Now, I'm not sure that's really what's going on, because certainly if you talk to economists, the majority, almost 75%, think the Fed will raise interest rates again in June, particularly in an environment where, for a while the Fed was worried about global risks, it was worried about financial conditions, but over the last few months we've seen concerns about China's economy fade quite substantially. And also financial conditions have improved quite markedly as well. I mean, obviously the S&P 500 has increased back to where it was at about 2100. We've seen bond yields come down quite sharply too, corporate bond yields and sovereign bond yields. And also, as I said, we've seen the dollar weaken a little bit as well. So I think certainly in this environment, there's no reason why the Fed shouldn't raise interest rates as soon as June. After that, we don't expect the Fed to raise interest rates twice more, taking the Fed funds rate to between 1 and 1.25 by the end of this year. And in this environment that we're talking about, where inflation rises a bit more rapidly than either the Fed or the markets expect, we'd also expect interest rates to be going up more sharply in 2017 too. So in that case, we'd expect interest rates to go up to 2.25 to 2.5 by the end of next year. Would that be enough to do any damage to the US recovery because we have an environment of raising interest rates? Well, I don't think so, because in terms of judging the overall tightness or looseness of monetary policy, economists think about this in terms of real interest rates. So that is nominal rates minus the rate of inflation in the economy. At the moment, real interest rates are deep into negative territory, and you can see that historically that's a fairly unusual position to be in. Real interest rates are normally positive, and indeed whenever we've seen a recession in this economy, it's come after real interest rates have got up to at least plus 2%. At the moment we're close to minus 2%. So for me that suggests that we're absolutely nowhere near the position where the Fed is going to kill this recovery. And of course in an environment that I'm talking about where inflation is going up, the Fed has to keep pace in terms of raising nominal interest rates, otherwise real interest rates are actually going down. That means that monetary policy is actually becoming looser. The cost of capital is actually going down. So even in the environment I'm talking about where inflation goes up by a bit more than expected and nominal interest rates go up by a bit more than expected, I'm still talking about an environment where monetary policy is actually on a fairly loose setting and shouldn't do anything, at least over the next 12 to 18 months, to choke off the recovery. That doesn't mean it won't eventually begin to slow economic growth, but I think that's still quite a way in the future. Our forecast suggests GDP growth will be around 2.2% this year, which again, as I've said, is pretty much close to what we've seen as the trend over the last few years. We would, however, expect it to slow a little bit as interest rates are going up going into 2017. Well, not on this chart. I think 2018 could be when we start to see a more marked cyclical slowdown. I don't think there's any danger of an imminent downturn, serious downturn this year or even next year. But if we're talking about 2018, and certainly by the time we get to 2019, by that point I do think we could be in a position where we could see a normal cyclical downturn in this recovery. Now that doesn't mean we're going to see a collapse that we saw in 2008. I'm talking about a more gentle post-war recession of the sort we saw in 2001. But I think where we do probably differ most from the consensus in expecting inflation to rise over the next couple of years. Now, how does this come through in our market forecasts? Well, although we're fairly bullish about economic growth, or as bullish as you can be in an environment where potential economic growth is pretty low, that doesn't necessarily mean that's going to be a fantastic thing for stock markets. The environment I'm talking about is one where not only is price inflation going up, but the big thing is that we've got a lot less slack in the labour market, and that is probably going to come through in terms of much stronger wage growth. Now, of course, stronger wage growth means lower margins, lower profits, and so I think as far as stock markets go, it's going to be a bit of a struggle. Particularly also if we're right, and obviously we've got a global environment where the US Federal Reserve is beginning to raise interest rates, but other central banks globally are still either keeping policy as loose as it is at the moment, or maybe even trying to loosen it further. And I think that'll lead to some appreciation to the dollar, which obviously will hit profits of multinationals as well. So fairly bullish on the overall US economic outlook. That doesn't necessarily mean it's going to translate into a fantastic performance for US stocks. I think it's more likely to be a case of grinding higher. But we would expect to see more of a rise is with long-term treasury yields. Obviously they're very, very low at the moment. Now to some extent I think that's because people have convinced themselves that interest rates are going to stay low even in this economy for the foreseeable future. But I think that's all going to change in the next 12 to 24 months. As I said, it all comes down to an economy that gets close or at full employment. You would expect to see a pickup in inflation, and that's the cyclical change I think we're going to have over the next couple of years. So that's the tour of the US economic outlook. I appear to be just about on time. We'll spend the last 10 minutes looking at a couple of global risks. The first one is one that I'm sure you're all aware of, that we get a lot of press coverage on, media coverage, which is what's going on in China. A little less coverage, but I'm going to talk to you a little bit about Canada and particularly its housing market, and also draw some parallels between what's going on in Canada's housing market and also what's going on close to home here in America with the US housing market. And then just a few remarks also on Brexit. Obviously I have the accent to discuss the UK's referendum on whether it should stay or leave from the European Union. Obviously over the last 12 to 18 months the emerging markets miracle has pretty much fallen apart. We even had the acronym BRICS about how Brazil, Russia, India and China were the growth economies, and this is where they're going to be the engine of global growth. They're going to drive us through the 21st century, and unfortunately a lot of that has fallen apart. In Russia and Brazil, that was a lot down to the strength previously was dependent on commodity prices, and obviously now the commodity prices have fallen back. Those economies look a lot weaker. In China, it was simply that you can't have an economy like China growing at 10 or 11% per year on a sustained basis. As we get these countries up from very low incomes towards middle income status, we always see these economies slow in terms of their growth rates. We've seen it happen with the Asian tigers. We saw it happen a generation ago with Japan. And we're now beginning to see it happen with China. China is, all the low-hanging fruit in China has now been taken. They've moved people from rural areas, they've developed their manufacturing sector. But the difficult thing now is to transition from being a manufacturing and export-intensive economy to a more balanced, service-based, consumption-driven economy. But also, if you've got a service-based, consumption-based economy, you should expect economic growth to be slower. It's simply not going to be 10 or 11% anymore. It is going to be 5 or 6%, which is just a more sustainable rate. I've talked about US economic growth. The potential is perhaps 2%. If we talk about Japan, the potential is perhaps 1%. Europe, it's perhaps 2%. So with developed economies, we have much lower potential growth rates. With frontier economies, those that are just beginning to develop, we can have very, very, very strong growth rates, but China is transitioning out of that sort of frontier emerging market and becoming almost a middle-income country now. So we would naturally expect some growth to slow. So what are the current concerns about China? Well, obviously earlier in the year we had a lot of attention on the collapse in China's stock market. More generally, economic weakness. We've also had some discussion about China's currency, the renminbi, and whether capital outflows would force the Chinese to devalue that currency. And also just generally the competence of policymakers, not just how they've dealt with their response to the decline in stock markets, but also how they've dealt with their currency policy. Now this chart shows you China's stock market over the last decade, basically. It's basically a flat line with two great big bumps in it. And the two great big bumps were quite obviously bubbles. The key thing is that China's stock market is completely and utterly separate from its economy. What happens in the economy has very little impact on the stock market, and what happens in the stock market has very little impact on the economy. You can see that the latest run-up in the stock market actually only started in early 2015, which, as I'll show you in a second, was exactly the time when the real economic growth was slowing. And Chinese stock markets then fell back quite dramatically in the second half of the year, at the same time as Chinese economic growth was stabilising. So when somebody tells you that China's stock market is a signal of anything, I think safely you should just ignore them. Now, of course, there's been some question about whether China's economic statistics are actually valid, and we think there is some legitimacy to those claims. So what this chart shows you is China's official GDP growth series, which is the red line. And we always also calculate our own, what we call an activity proxy, which is we use that, an aggregate of things we can actually measure tangibly in the economy, cement production, airline trips, things like that we can actually put a handle on, electricity generation, that would normally be pretty good proxies for activity in that economy. And certainly looking at that proxy, obviously it had a fairly close relationship with the official figures up to around 2013. But it does suggest that the official figures are overstating growth at the moment. We think growth is probably nearer 4 or 5% over the past year or two. Now that obviously is negative, I guess, because it's weaker than the official figures. But I think the other thing you should take away from this is that even if you use our measure, Chinese economic growth has not slowed since early 2015. We have this structural slowdown, but it's not turning into the collapse that people were warning us about over the last few months. If anything, it appears to have stabilised. And one of the reasons why it slowed in early 2015 is because the Chinese actually had an almost inadvertent fiscal tightening in late 2014 and early 2015, which actually had a knock-on impact on wider economic growth. The one thing we can say since then, of course, is that the Chinese have done quite a lot in terms of policy stimulus since then. We've seen, obviously, interest rates come down, we've seen reserve requirements go down, and that's led to resurgence in credit growth in the economy. Now, of course, we don't want economic growth driven solely by credit growth, but it has been enough in the short term to give the economy a shot in the arm, and it appears that economic growth not only is stabilising, but may actually have rebounded a little bit. So I think concerns that the Chinese economy is about to collapse are vastly overdone at this stage. So as I said, stock market, very bad guide to what's happening in China's real economy, but equally China's real economy is a very bad guide to China's stock market. The economy is not collapsing, the support's coming through, and it appears to be doing okay. Though, as I say, the medium-term outlook is maybe not as good as it was. What we have seen over the last few months, I guess, is that policymakers haven't done quite as well as we would have hoped. In an economy like China's, which is very much what economists would call a command economy, or it's like the old Soviet economy, where policymakers should be able to control everything. The Chinese haven't done a very good job of it, either in explaining what their exchange rate policy was, or in terms of actually getting this stimulus through into the economy. I think that's perhaps something we'll bear in mind in the future. But overall, China's not the disaster some people thought it might be. Now Canada, I'm not sure if all of you are aware, despite my accent, I actually live in Toronto and have done for many years. Now Canada, obviously, is not something we hear a lot about, at least outside Canada. But if we're talking about big trading partners for the US, Canada actually is bigger than China. And Canada's economy has been whacked sideways by the collapse in crude oil prices. The US economy has survived because shale oil is still a pretty modest part of the economy. But for Canada, oil is a much bigger part, and obviously therefore the aggregate economy has suffered. Now that's come through in terms of a slump in corporate profits. That's hit investment. Remember we were talking about mining investment earlier. Well, the impact in Canada has been bigger, not because mining investment has gone down by more, but because mining investment is a much bigger share of the economy. But I think the key danger is that Canada's economy has just about survived that slump in oil prices. As I said, now that commodity prices have levelled out, the worst is perhaps behind us. What I spend a few seconds on is talking about Canada's housing market. So, of course, we had the bubble in US housing. This chart shows you house prices. They're indexed so they're both equal to 100, Canada and the US, in the year 2000. And you can see that between 2000 and 2007, yes, growth in house prices was stronger in the US. But the key difference, of course, is that house prices in the US then fell back, whereas in Canada they just kept going up and up and up and up. And now, if we go back to relative to 2000 levels, they're 260% higher, whereas here in the US they're only 170% higher. Now, of course, that's crazy. Crazy stuff. Let's look at this in terms of, as economists, how do we measure whether housing is good value? Well, we try and look at the house price to income ratio. So how much can each person afford? And you can see the blue line again is the house price to income ratio for the US. And we could see there was a very clear problem in 2006 and 2007. We've normalised this chart, so 100% is the long-term average. So at the peak, the blue line was at 130. That means valuations were 30% above what we would think of as fair value. Of course, when house prices fell back in the US, that took us back below fair value. So even though house prices have rallied again over the last couple of years, and you've begun to hear a few people say in America that, oh, American house prices are overvalued, we're in trouble, it's a new bubble. I don't think that's the case. As far as we can tell, based on this metric, US housing still looks pretty much just a little bit undervalued, if anything. Now, of course, this is an aggregate national measure. I'm not going to argue that some areas don't look overvalued, such as San Francisco, for instance. But on a national picture, it looks okay. But that's markedly different when we turn our attention to Canada. In fact, the house price to income ratio is now higher than it reached in the US during the peak. Debt, too. If you're looking at asset price bubbles, always look for the credit bubble to go with it. We could see it in the US. Again, the blue line, the household debt to disposable income ratio went up to 170%. Again, it came down significantly. And I talked about the fundamentals for the US and consumer being pretty good. It's not just about employment, it's not just about income growth, it's also that the household debt burden is much lower than it used to be. But that's a much better story as far as much different story as far as Canada is concerned. So although we wouldn't be so negative on China as some of the media coverage you read, we would perhaps be a bit more worried about Canada than you get in the media. A lot of that is because we've got the overhang from the drop back in commodity prices, and our big fear is that that's going to be compounded by a possibly quite severe drop back in house prices at some time in the near future. As I said, with overvaluations at more than 30%, I don't think this could go on much longer. And I think we would refer to Canada's housing market not unfairly as a ticking time bomb at this stage. Now I'm just going to finish with a few comments about Brexit. For those of you who aren't aware or are up on your UK politics, in late June the UK will be holding a referendum on whether it stays or leaves the European Union. If it does vote to leave, then that will set off 2 years, a minimum of 2 years of negotiations on exactly how it will leave. And I think there's a wider fear that if the UK leaves, then maybe that could begin to cause a bigger splintering of the European Union. Now, I should stress that the European Union is the trading bloc within Europe. It's not the single currency, that's what we would call the Eurozone, and the UK was never part of the single currency of the Euro, but it is part of the trading bloc, which we refer to, the 28-nation trading bloc, which is the European Union. Of course, at the moment, markets don't really appear to be pricing in any great fear about this. Sterling's a little bit weak, but we can't see it really coming through. I mean, if anything, markets have obviously been looking pretty good over the last few months. And that's perhaps surprising when you look at this, because some of the opinion polls are quite close. They put the vote fairly close. But when we look at the probability as far as betting odds, they're much wider. And we see that the smart money, if it is the smart money, is still very much weighted towards the UK remaining. In our view, we think the UK will vote to stay in. But this isn't a clear-cut vote. It's possible that it could swing over the next couple of months. In particular, if we saw anything like another rush of refugees coming into the UK during the summer season, if there are any more terrorist attacks in Europe, that also could weigh heavily. So I think it's something we should bear in mind. So what would the economic impact of Brexit be? Well, I think, to be honest, both the gains and losses are exaggerated. For the UK, it might very well lose a little bit in terms of trade with the European Union, but it should be able to negotiate trade agreements with the EU and also with other WTO countries. That means its overall position is not that much changed. But I don't think it's a big effect. The other thing that could go in terms of the UK's favour is that anything it loses in trade in terms of not having slightly higher tariffs might easily be made up if the result of the UK leaving is it ends up with a weaker exchange rate because sterling falls against the euro. The UK is a fairly open, small economy. It does an awful lot of trade with the EU, so certainly if it saw a weaker currency because of this, that could easily offset any negative impact from slightly higher tariffs and slightly higher barriers to trade with the European Union. I also don't necessarily think this is going to trigger a wider discussion about whether Europe is going to remain as a single institution in many ways. The UK has always felt a bit of an odd man out within Europe. Geographically it's on the edge, culturally it's on the edge. And the UK is always also in a strange position in that despite being on the outside and not driving policy like maybe France and Germany does, it still actually contributes in net terms quite a lot towards the European Union. Whereas the other countries we would naturally expect to follow the UK, which might be the Czech Republic, it might be Hungary, those countries have a lot more to lose if they did leave the European Union because they actually are net beneficiaries in terms of their budgets from being members of the European Union. So I think even if the UK leaves, that doesn't necessarily mean that the next most likely countries will follow, simply because it's not in their economic interests to do so. And that, I think I've just about talked myself hoarse, but I'd be very happy to take everybody's questions, either on what's in the material, Any other subjects on economics? The Hawks' performance last night? Whatever you like. Yes, please.
So you're projecting a flattening yield curve in the U.S. by the end of 2017 as I'm looking at that chart, with Fed funds going to 2.5, 10-year Treasury at.
Absolutely. And that's a very deliberate forecast. So the environment I'm talking about, where inflation rises, it's a normal cyclical response. You see the Fed realises it's behind the curve, pushes up nominal interest rates. Now eventually that's going to topple the economy over. And when it topples the economy over, you'd expect by that point not just that the yield curve is flat, but actually that it's even maybe inverted a little bit. So I talked a little bit about how I thought we're not in a danger of recession now, but that I thought that we could see one maybe late 2018, early 2019. And part of that, an element of that story, adding to that story, is that's why we would have the yield curve very deliberately flattening out by the time we got to late 2017, early 2018. I think that was the next.
The Canadian house prices, how much of that do you attribute to foreign buyers, particularly from Asia, pumping parking money in
It's
Canada?
a very good question, and I have absolutely no idea.
Okay.
And the other thing is nobody else has any idea whatsoever. It's one of those areas where it's very hard to get data on the nationality. It doesn't exist, at least on a national basis. It's all down to anecdotal information. Sorry, I rushed the Canadian housing topic a little bit because we were short on time. But the overvaluation is almost exclusively in two cities, which is Toronto and Vancouver. And certainly in terms of Vancouver, we know that it has a very big Southeast Asian population, a lot of them coming directly from China. Even with Toronto, it has a very big Southeast Asian population. But whether that's money coming directly from China, it's much harder to tell. When it is money coming through that, though, I would expect it to show up in the very top end of the market, which in Vancouver means spending $5 million on a home. And therefore I expect a much bigger gap to open up between what I would call luxury real estate and average real estate. But actually what you've seen is the whole market's gone up. So I appreciate it's a factor, but I don't think it's the overwhelming driver. I mean, I showed you the debt chart. That's Canadian household debt. That's, even if some of this is being driven by cash buyers coming from China, there is a problem with Canadians having too much debt. And they've used that debt to buy overvalued housing. And we saw that happen in this economy when it all fell apart a decade ago. I'll take this one and then the lady at the back.
Staying on that topic, what about supply? Is there an issue with overbuilding or lack of building, and therefore the prices can burst, but you're not going to have a truer rise in unemployment because builders and all those related industries get hit by a collapse?
Yes, it would certainly be very negative if we did see a downturn. I mean, I've talked about this very much in terms of house prices, but you're absolutely right. The other thing that we've seen in Canada, that we saw in the US as well, is that when you see obviously a rapid run-up in this case house prices, that's also reflected in terms of people want to build a lot of houses. And we've seen that happen in Canada too. Not so much in terms of single-family homes, but we've seen an incredible amount of condo building, which of course, as everybody remembers, we saw a lot here, a lot in Miami, Florida. So one of the key, there are two ways that a housing downturn hits headline GDP growth. One is that you've got a loss of wealth, and that hits general consumption growth. And the other is that you have a big drop-off in residential investment. Basically, people are no longer building condos anymore because nobody wants to buy them. So if we're right about this, I'd expect it to come through in both channels. Sorry, the lady at the back.
You terms of oil prices, you said that they have normalized around 40. But is 40 a sustainable price for projects to be valid? And where do you see oil prices going in the medium term?
The view of our commodities economists, which is my way of shirking all responsibility for it, the view of our commodities economists, and I think it is a pretty fair view, is that oil prices will grind higher from where we are now, that we'll probably get back to around $50 to $60 a barrel. If not by the end of this year, then probably by the end of next year. A lot of that is driven by just a drop-off in US production. So I talked about we've seen a massive drop in drilling activity. So we had 1,500 active drills, we've now got 300. But what we haven't yet seen is a big supply response in terms of US production. One is because they were drilling these wells so fast that they weren't having time to actually pull the oil out the ground. They were just running around, putting the drill in the ground, capping the hole and then going on to the next hole. Well, they've stopped making holes, but they haven't pulled everything out yet. And when you think about pulling it out the ground, you've already paid for the drilling, you've already paid to set it up. So, you know, the marginal cost of pulling it out the ground at that stage is very low. So they will do that. So there's a backlog there. And that's why we've seen production stay close to record levels. It was like 9.6 million barrels a day. But if you look at the EIA's own figures, that suggests that production this year will drop off. It'll go down to about, I think, 9 million barrels a day. I think that would be enough, maybe combined with it, if other countries actually get their act together and work together, to maybe push prices up a little bit. Now, should prices go even higher because the marginal cost is above $60 a barrel? Well, I think for here in the US with shale, it's such an interesting technology because it's so new and it's improving so dramatically, and the efficiency gains in it are so dramatic that if we went back even 3 or 4 years ago, the break-even cost was probably $80 a barrel to pull it out of the ground. And I must stress I'm not the expert on this, but from talking to people, oil analysts, they're now saying, oh, maybe it is $60 a barrel, and if we jump ahead another 12 months, 2 years, in some cases they might have this down to $50 a barrel. So it's finding that balance between, you know, we're definitely going to get some rise in prices from where we are because there's going to be a supply response, but at the same time the supply response is going to be fairly modest because, you know, US shale is going to be a lot more cost effective than it was when the technology was super brand new a couple of years ago.
Well, I enjoyed your presentation today.
Thank you.
Just talk about the international situation a little bit. I know you mentioned the maturing economies and the resultant slowdown in the GDP of the tigers and the BRICS, compounded by the low commodity prices. Are there some specific countries or a group of countries who you see might be engines of growth over the next 3 to 5 years?
Oh, wow. No. I mean, we've obviously gone through a period where, as we say, emerging market growth has been very strong. But nearly all of that can be traced back to China. China has undergone something of a revolution. It's become much more of a market economy. As I say, it had the potential in terms of resources to push the population away from rural areas into urban areas. It became a centre of manufacturing. It could copy what other countries have already done in terms of manufacturing processes. So it enjoyed very rapid productivity growth. And if you add that compounded to its labour force growth, you got a very, very strong growth. That was what drove the growth in commodities, and it was also what drove the growth in a lot of other emerging markets, which were obviously closely integrated in the supply chain with Chinese manufacturing. But I think that was a one-off deal. You can't, as I say, as China becomes a middle-income country, you can't feasibly expect economic growth to be that strong. With the developed economies, we've got ageing populations across a lot of them. And obviously productivity growth has been weaker than we would have hoped for, and we don't have a really convincing answer why. So I think that, we can't hope for too much from the developed economies. And that leaves us looking around the world, okay, where's the next China story? India. Well, India is obviously a big country, 1 billion people, but it's always had problems in terms of driving growth. It's never been particularly organised. If you travel to China, the infrastructure is still very poor in some areas. And I think in terms of education levels, it's a lot of the rural areas, it's lower too. So I think India is going to really struggle to replicate what's happened in China over the past couple of years. And the only other one is probably Africa, which again, it's hard to see that in the next 10, even 20 years, simply because of education levels, and it's not integrated into the global economy as far as trade routes. It's hard to see that become a centre of low-cost manufacturing. So unfortunately, we may be in a world where global economic growth, for those reasons, is low.
One more question, Carol?
I got 2 hands up. I don't want to disappoint. Sorry, can we keep going, or do you want?
No, sure.
We keep going? Oh.
I can make one very
Sure.
simple. What do you, everything's simple in economics, right? What do you attribute, you talked about the disconnect between the Chinese economy and the Chinese stock market. Curious what you attribute that to, and if that's pretty much true for most emerging markets.
I think it's more true in China. I think that it's simply because the Chinese stock market isn't very big, and it's often driven by credit margin, and a lot of growth is being driven by nationalised firms that aren't necessarily on these stock indices. And also, it doesn't have a knock-on impact back on the economy because there are very few Chinese that actually own equities. It tends to be only the very rich ones, and whether they lose a little bit or make a little bit, that's not going to change. That's not going to change their overall consumption behaviour. Yes, please.
What is your expectations about interest rates in Europe? Do you see the European Central Bank following a similar path, or do you see them keeping their interest rates lower?
We don't think we're going to see European policy getting tighter anytime soon. There are still problems as far as structural problems as far as the Eurozone is concerned. German growth has been much better, but if you look at the peripheral countries, at least outside of Ireland, they're still struggling to grow. What we would like to see is more fiscal stimulus in Europe, but of course that's the one thing that we haven't seen. And even German economic growth has been driven mostly in terms of stronger export growth but that's only come at the expense of its closest neighbours. So it's more distributing economic activity, redistributing economic activity around the region rather than expanding overall activity. So we think we'd expect Eurozone growth to be very, very modest. In that environment, we'd expect Eurozone monetary policy to remain very, very weak. It's possible at some point the ECB will try and make monetary policy even looser. Obviously, as you know, it already has a negative interest rate. It's already buying bonds as part of its quantitative easing. There are limits on how far into negative territory you can push nominal interest rates, because if you charge people too much to hold their money at the bank, they simply decide they're going to take their money out of the bank. Now, we don't know what that limit is, but there is a limit, and at some point, the ECB will reach it. In fact, they've even suggested that they might be close to the limit. So I'm sure they can do a little bit more in terms of quantitative easing, which I don't think is necessarily going to be effective, particularly not in an environment where long-term bond yields are already very, very low or even negative. in terms of other conventional measures, you're pretty limited in how negative interest rates can be. More hands. Sorry, I'll take the latest question.
I saw an analysis recently of the loan participation rate in the United States, and as you said, part of it is due to a lower participation by the older senior citizens, but that wasn't very big, actually. The decline was pretty nominal. The biggest decline was in the 25 to 34-year-olds, that age group. And I was curious as to if you've done any analysis and know why that would be the case.
I can answer that one, yes, which is good. It's not so much the participation rate within each age cohort. It doesn't matter that the participation rate for 20 to 25-year-olds may have gone from 25 to 24. The big thing is that everybody shifted out of the 50 to 60 age cohort and gone into the above 60 cohort, and that has a much lower participation rate. So think about it in these terms. The baby boomers, the earliest baby boomers were born in the late 40s, early 50s. So that means for women they reach the age of 60, so retirement in 2010. The men are retiring at 65. That means they reached retirement age in 2015. So we really do have this spike in the birth rate that occurred in the early 50s, late 40s, and went on through to the 60s. And now that spike in the birth rate is coming through into a spike in number of people retiring. So they're going from when they were 50 and 60. And when you're 50, 55, I think the participation rate for that group is still about 70%, pretty healthy. But when we go above 60, it drops to about 40%. And when we go to above 65, it drops to 20%. So it's not so much the participation rate within each age cohort, it's the fact that everybody's moving through the cohorts of age, and they're all now in the 60 plus. And the 60 plus participation rate has actually gone up. It's just that it's so much lower still than what it is for 50 to 60-year-olds. Now on top of that, you are right about 20 to 25-year-olds. One thing we've seen in the participation rate over the last couple of decades is that it has been going down for those aged between 16 and 25. And obviously the key reason for that is those people are staying in education for longer. The 20 to 25-year-old group is really all about those doing secondary degrees, doing master's degrees, doing MBAs. But that's a good thing for the economy because people should be in education. We shouldn't be competing in terms of low-skilled jobs with the Chinese. We should be trying to educate the workforce, make them more skilled. So I'm okay with the participation rate falling for 20 to 25-year-olds and that going down a little bit.
Well, it wasn't 2025, it was like 25 to 34.
Okay.
It was a 10-year, and that, so...
That overall
that was
is...
the one that had
yes.
the biggest decline.
That overall, yes. But as I say, it's not so much what's happening within each cohort, it's that so many millions of people are moving from one cohort where the participation rate is 70% and going into the next one where it's 30%. Sorry, yes please.
Yes, some of the presidential candidates here in the United States are making the case that some of our trading partners are devaluing their currency, and it's having a negative impact on U.S. manufacturers. You're a Canadian, so you're kind of outside things looking in. Do you think that's a valid case, and if so, what would you do about it?
So it was a much easier claim to make that the Chinese were setting their currency far too low a couple of years ago. But since then, the Chinese currency has appreciated quite a lot. And what we've actually seen over the last few months is the Chinese have been actively going into the market to prevent their currency from devaluing. So they don't want it to devalue, they want to manage it so it's at a fairly steady level. So if you think about it in those terms, it's a little bizarre to be saying that the Chinese are doing everything they can to weaken their currency, because actually what they're doing is actively trying not to weaken it at the moment. Now, of course, there's the broader question about, obviously, trade, and has that been a negative for the US economy? Obviously, a lot of manufacturing has left the US. We used to have 19 million people employed in manufacturing. Now we only have 12. And a lot of that has moved to, obviously, to China or other emerging markets. The benefit of that has been, of course, much lower prices. Walmart is basically driven by lower prices all the time. Consumers have benefited in terms of you can buy more goods and services. I mean, remember, there are 320 million people in this economy. So if we look solely at manufacturing, there are 7 million fewer people employed. But all of you can own a lot more in terms of goods and services, or what you can buy with your incomes, because those goods, if they're coming from China, are so much cheaper. And at the same time, we've seen growth in other industries in the US economy. The services sector has obviously been generating quite a few jobs over the last few years. Now, there is a debate about whether we're generating good quality jobs. I think that's perhaps a fair question. But overall, I don't think that simply raising a 30% tariff on all imports is going to do anything dramatic to bring manufacturing back to the US. And you also have to be careful, because if we put tariffs simply on China, then the manufacturing production is going to move to the next lowest cost base, which probably isn't America. It's probably Vietnam, or it's Bulgaria, or it's wherever else it is. But it's not necessarily going to be here, because other countries are willing to produce these goods for a lot cheaper than American workers can. So I think it's probably best to specialise in other areas.